Here we go, finally recording, and let's start with a session where I'll try to explain the conceptual difference between contracts for differences and futures, explain as well the Darwinex CFD offering, which is not a usual CFD offering. As you'll see, it overcomes many of the typical shortcomings of a traditional CFD. We'll conclude with a reasonably obvious conclusion, explaining to you guys which of the two contracts suits you better. And then I've got some news that I always like to spread to the loyal guys who come with me in these to these sessions. So, but more on that later. As ever, if you have any questions, feel free to write them. I'll try and tackle them if they're relevant to what we're discussing, and if not, I'll defer to the Q&A section at the end of the session. So, without further ado, as you can guess, the first thing to clarify is to explain the core difference between an over-the-counter market and an exchange. Because believe it or not, there's a lot of people who trade for years and then never really get to understand the difference between either. So on the left-hand side, what we've got is a stylized description of a bilateral over-the-counter market, which with, say, 5 participants. And the key insight here is to see that everybody is trading bilaterally with each other. So there are as many relationships as pairs of counterparties are interacting with each other. Now, contrast that with a CCP, and I apologize because this was left over from the Spanish session, like a central counterparty, a topic on which you'll have plenty of information in Google, which is an additional participant to the market whose sole function is to be the middleman between everybody else. This might seem a trivial innovation, but actually it isn't. It's a crucial improvement on the left-hand side for a number of reasons, and those are the fact, and by the way, this is not me saying it, this is actually the market speaking for experience. So most of the world's liquid plain vanilla assets, and by that I mean stocks, futures, interest rates like bonds, government and corporate bonds, and so on, they tend to list on an exchange, which is another way of describing a centralized counterparty. A centralized counterparty is one of the attributions of an exchange. So it's not me just kind of blowing the CCP trumpet. It's actually the voice of hundreds of years of experience, where at some point market participants have decided that they're all better off by introducing this kind of uber middleman than they are by liaising with each other bilaterally. And the reason for that is that when there is a centralized counterparty, all the liquidity goes via a single order book, which means there is one public price that is available and disclosed to all market participants. This order book is open, meaning that all the participants can both take but also make liquidity, which is something relevant, as we'll see in a second. It is anonymous, and you'll see the benefits of that in a second. Everybody is facing the central counterparty and doesn't know who's at the other end of his trade. And it has pretty big benefits when the going gets rough, speak Brexit or Swiss franc debacle, whatever that's been labeled, in the sense that exposures are net. And all those 4 are relevant for US traders. Let's see in a second why. So what's the importance about this single public order book? Well, basically, an order book is a fancy way of calling that a two-sided queue, where the guys who want to buy something queue up on the bid, and the guys who want to sell something queue up on the ask in descending versus ascending order. So the bid and ask for the 2 guys that are closest to each other make up the market price. So whenever these 2 guys agree that they should both give half a tenth of a pip, then the market price is kind of closed at that level. And you can also see not just the market price, but the market depth, the flow and the tick level changes of the market of the order book that results in the price. Put it another way, the price is not something which comes out of the blue, but actually the result of demand meeting supply, all demand, mind you, meeting supply in a public venue so that everybody can see the market price, which is the result not of what people are saying they're willing to trade, but actually what they have actually traded. And that is a difference. Okay, so there's a public price discovery mechanism that allows you to do that. And this basically this is what makes futures a more transparent asset class than CFDs, as we'll see in a second. More importantly, what we've got is symmetry of information. Everybody knows what everybody else is doing, which means everybody has the same opportunities. There's no guy who knows more than the others, the way can happen with other systems, as we'll see later. The second point is the fact that all orders into the order book are binding, meaning there's no concept of last look. And you're probably wondering, what does this last look mean? Well, let's just go into the different ways of functioning of an organized market on the left-hand side, of which, say, LMAX, one of our LPs, is one of our LPs, and actually our single LP for CFDs is an exponent, versus the ECN approach, which is slightly different and inferior in the sense that there is last look. So what we've got here in an organized market is there's people who are providing limit orders. They are liquidity providers, so market makers. Anybody can be a market maker in an organized market by simply entering a limit order where they set the price, but the fill is not guaranteed. And then there are, of course, makers who take whatever market price and just choose to enter into the order book by matching one side. Now, all those two sides queue up, as we've discussed, on both sides of the order book. And then whenever something has been matched, then there is no possibility for either of the two parties to a transaction to backtrack and say, you know what, actually the market price is moved against me, or I've got too much risk long the euro dollar, or whatever. I can't honor the promise of the order that I had made. Now, at that point, obviously, the guy on the other side has a very good reason to be spooked, saying, hey, you should have thought of this before entering into a binding contract, because now, for me, there's been the missed opportunity cost and time of not having entered the order book with the next best order, and now I'm bound to get a bad price because of you. Now, that's a whole lot, very long way of describing what people know as a requote. A requote is essentially just that. So the dealer has been offering to trade at price X. You take that price X, then that price moves your way, and the dealer says, hang on, I don't like this price anymore, but I'm still okay trading at this other worse price. Then at that point, you can tell the guy, well, thank you, but if I had known, would have traded with somebody else, which is, by the way, another option you get in a market. Everybody's trading with everybody. So, if you don't go with the first guy, you can always go with the second guy. Whereas when you're trading with a CFD, you're trading with the only guy, the market maker, and that option is not there. So it's basically a game where the market maker dictates the rules, and all you can do is walk away. But as long as you stay in the game, you're playing with his rules. So that's the lack of last look. Now, how can you track that? Well, and this is, by the way, one of the reasons we have introduced the execution quality section in the Darwinex page, is that you can track two parameters. One is the execution speed, how many milliseconds lapse from the point where your order reaches our servers until they are matched by the two liquidity providers, or the two prime brokers that we've got. And also, of course, if there were inefficiencies in the market price, then of course they're all obvious for everybody to see, and everybody could scalp them in a public order book. Whereas you can't do that if you don't even know what's going on there. Apologies for that. So. We'll talk about the binding liquidity. Then, of course, there's the point of anonymity. I've chosen to put here a screenshot of an online poker game to highlight a very important point. When you're trading with a CFD with a market maker, the market maker, in addition to setting the price for the CFD, has a lot of information that could be useful. They know where your stop loss and take profit is. They know your past strategy. They know your account balance. They know a whole lot of information, including, of course, your leverage, which could be used, particularly when you take into account that, say, when you're trading MT4 CFDs on MT4, MT4 has the possibility of streaming one different price feed uh, to every customer. So, there's Peter he's very close to a stop loss. He could be called theoretically, technically, he could be called a price that basically kind of takes his stop and locks in the loss. Whereas every other customer in the whole thing wouldn't even know because they're all different, seeing different price feeds. So that's one of the things that the problem with the single order book not being there creates, and the fact that the anonymity is not there compounds it, because of course they know by how much they have to move your individual price feed to essentially hit you. So that's kind of bad, and it creates an information asymmetry. And last but not least, and this is not relevant directly when you're trading, but it is relevant to you in the sense that your money is with your counterparty, and if that counterparty were to go down, then your money would go down with it. And basically what happens here, so let's say when in an OTC situation, when we see on the left, let's say, we're talking about the euro dollar. In this case, A is short 100, the euro dollar with B, and long 80, the euro dollar with C, and similarly with B and C. You can see the direction of the arrows. So net, B is long 10, A is short 20, and C is a long 10. But if for whatever reason, let's say a huge movement in the euro dollar, or the whatever big currency, say the Swiss franc, basically makes one of the counterparties go default, with things going C's way, well, it could be that B goes default, takes down A, which then ends up taking C down, and that creates a huge whole mess, which takes months to untangle. Now, this fact is actually one of the reasons that, in my probably foolish optimism, I still think that regulators will someday force Forex on exchange to make sure that all these risks don't continue there, because there was a big call of attention during the Swiss franc thing. You know what happened to FXCM. Saxo lost the whole bundle. And those are the two guys that were publicly quoted, so we know what happened. Imagine what did happen with all the unlisted market makers who probably just barely escaped going bust on that day. Okay, so it's in everyone's interest to minimize counterparty risk. And of course, you're probably saying, well, here's Juan again, right? He promises a webinar on CFDs versus futures, and we haven't even talked about it yet. So let's summarize. So future left-hand side versus CFD on the other side. First, the order book. So it's a single order book on the futures, as we've described. So there's one price equal for all participants, whereas with the CFDs, it could be that others are crossing at different prices that from what you're getting, and you'd never know. There's the possibility of last look does not exist by law in an organized market, whereas it's basically the market maker's prerogative in a bilateral CFD. The future is anonymous, whereas the CFD isn't. Again, that's the asymmetry of information we've discussed, counterparty risk, and then of course the price finding point. So in an organized market that because all supply and all demand is there, or in theory, the price should be the best possible you could have. Now, this is, by the way, one of the biggest risks of market integrity, in the sense that there are increasingly more electronic dark pools where people are exchanging, trading with each other bilaterally by basically free riding on the price of the public exchange to transact privately with a price that doesn't always, and certainly not in real time, get back to the public order book. So that's one which is a problem. In the case of a bilateral CFD, again, the price is whatever the CFD provider decides to quote you, and only you, because he could be quoting different prices to different people. So you're probably now asking yourselves, so here's all the guys from Darwinex. They pride themselves in offering decent trading, and here's Juan talking for 15 minutes about what a potential bucket hole CFDs are. So why did these guys even offer CFDs? And there's a whole bunch of customers who have already approached us, and this is one of the reasons we're holding this webinar. So well, there's two reasons why we do that. The first one is that CFDs are more accessible. So it is true that you've seen all the theoretical benefits of the future, but the fact is, if you've got a 1,000, 5,000 euro account, it's probably not recommendable that you go into full future lot. So the contract size, for one, is something which has been lacking for years, and exchanges who really are not used and not liaising directly with final counterparties are still being very slow to react in reducing the contract sizes to a more accessible minimum denomination. I hope that will change over time. Second is liquidity. So the futures obviously trade for the opening hours of the organized exchange. The CFDs, I agree, with low liquidity, but still allow you to have 24-hour liquidity in many assets, and that is a benefit if you're not moving large positions. Thirdly, the cost of data. So obviously, the exchanges don't want people to free ride. So the way to monetize the function is to charge for the data feed, and they tend to charge for a fee which is not proportional to the trading volume, but rather a fixed fee, and that discourages. The smaller the account, the higher the discouragement to actually trade futures versus CFDs. So the spread I haven't really mentioned, but like we have a competitive. Well, actually, in the CFD world, again, despite the fact that the CFD is a marked up spread, still, considering you're not taking oversized risk, and you're getting the small denomination, you have 24-hour liquidity, and you don't have to pay for the data. It could be that the marked up spread still overall, in absolute amounts, is cheaper than paying for the futures contract. And another risk, which I suspect is going to become more prevalent going forward, is the risk of a Tobin tax or a transaction tax, whereby governments, in their attempt to curb speculation, impose a fee for people who speculate or who trade, and that is possible in the futures because it's a physical asset that's being bought and sold, but it isn't in a bilateral bet by tax law. So that's the reason why a lot of counterparties enter into equity swaps. So that's one of the advantages. Okay, so this is one of the reasons why we offer CFDs. The other reason is that we offer different CFDs. So people think, and I apologize because I have a couple of Spanish words here left, that we offer standard bucket shop CFDs, but actually we don't. We offer CFDs that are standardized contracts listed on a MiFID multilateral trading facility, which is another way of saying an exchange, that is LMAX, and they don't have most of the problems that we've just talked about in terms of CFDs. Why is that? Well, because they come from a single order book. So everybody that's trading the CFDs on LMAX is trading on the same price, can be a maker and a taker of liquidity. There is no last look, so we do not have requotes. There's just no possibility for last look with our CFDs. I hope you have appreciated that. You can't have had a single reject. It is all anonymous on two layers. The first one is because we are a true broker, so you're trading our account, and every single one of our customers is trading our account. We do not disclose your account sizes to LMAX, and anyway, LMAX is a centralized counterparty that acts as an additional layer of privacy between us and the final liquidity providers who are actually competing with each other. So they can't quote whatever price they want because A, everybody's on the same price, and B, that price is fed by several LPs. So if for whatever reason they leave the market price, then they will not get hit, and it's not in their best interest. So let me put it another way. What our CFD offering is about as close as it gets to trading a future on exchange. Actually, it is trading a future on exchange, except for the fact that the contract is not the standardized futures format, and that there isn't as much liquidity as there is in the public futures markets, because let's face it, LMAX isn't that big still. Okay, but conceptually, it's the same thing, with the benefits that is still a lower exercise and so on. So the answer to those that say Darwinex should be offering CFDs is Darwinex really isn't offering CFDs in the sense that you think we are. So here's a question that I hope that I was hoping to get, and that's whether we are going to add the DAX soon. And the answer to that, Hans, is you can already trade the DAX. So the DAX is already accessible, but we have not yet concluded the work whereby the risk management engine will be able to list DAX contracts as a Darwin, because the DAX doesn't open 24 hours a day as we've introduced, and we're still adjusting the risk management engine to be able to cater for the gaps. We have our best guys actively working on that. I think the goal is to finish the work by July, test it for a couple of months, and then add the DAX so that everybody can trade both the DAX and then some more other stuff. More on that in a bit later. So to summarize, this is basically the basic recommendation. Now, you probably will start with a CFD with a bucket shop, because let's face it, everybody started trading because they saw some ad by some bucket shop broker. Once you figure out that what's bad about it, you'll try to get as close to the futures world as you can. If your account size warrants that from day one, then you should be trading futures. There's no point in trading futures, in trading even our sort of goodie CFDs if you can trade the real thing. But if your account is too small, then you're probably better off by trading CFDs on a market the way we do. That's why we offer them. And yeah, there we go. So the other point, Jesus is saying, asking about the IBEX 35, and the answer is this exactly same as the DAX. The only reason we're not offering all the indices that LMAX has, and LMAX does have the IBEX 35, is because of the gap thing. But we will add the IBEX whenever that's solved, and we're weeks away from that. And yeah, so that's one of the things. And then here comes the piece of news, which some of you may or may not know, but this is just to let you guys know that we are 99% certain of starting to offer futures. So we have already had advanced conversations with what we think are the best providers in the field, and the goal will be to start offering initially futures trading. Once we have got a critical mass of futures traders to basically polish the diagnostic algorithms, we will offer the Darwinex diagnostic algorithms on futures strategies. And after that, we will test for a while, and we will start offering futures Darwins. So in other words, we are expanding the universe of tradable assets to include futures indices, so indices on futures on indices, and also on interest rates. So we're becoming a fully fledged multi-asset broker. And the other piece of news is the back end that will power futures trading is multi-platform, meaning you will be able to trade with the most customary trading terminals, such as a NinjaTrader, TradeStation, multi-charts, the typical, of course, algorithmic trading, and so on and so forth, to a single backend, which will all link to the Darwinex backend for Darwin diagnostic and listing purposes. So I guess the piece of news is that I reckon within the next, for sure, 6 months, Darwinex will be a multi-asset, multi-platform broker, and one of the platforms we will offer, probably the default one for on web, will be TradingView, which is one that has been very demanded by our users, and we are listening. So there goes 3 pieces of news: popular trading platform, in addition to any other platform you want, which is compatible with CQG, which will be our backend, plus trading of futures, and yeah, basically we're getting there. So Victor is asking, are we able to trade Darwins on trading platforms? Yeah. Okay. Well, there's another piece of news coming. I'm giving a lot away, but basically we are working on a functionality that will allow that will basically allow you to list your Darwin portfolio as if it was a Darwin itself. So that's number one. And the other one, which is in the roadmap, but I don't know, I don't have specific timelines, will be to offer an API, a Darwin API, which will allow you to trade Darwins, initially on a long basis, potentially long term as well on a short basis. And I guess, yeah, it's interesting. Let's see how many people ask to trade Darwins on a trading platform. That's really not, there's a number of reasons why I don't think you should be doing heavy duty trading. But if a lot of people come back with that idea, we will consider it for sure. I know that my brother is very successfully kind of trading really Darwins on his own portfolio. He's doing pretty well out of it. So the need seems to be emerging. So Amujel is asking who will be our liquidity provider with futures, and the answer there, and this is the great thing with futures, is the liquidity provider is the exchange. So yes, we will have a clearing broker. That's still, it's probably going to be RJ O'Brien, although it's not fully decided. But ultimately, it doesn't care a hoot. It doesn't matter a hoot, because really the beauty with futures is that they are on exchange and that there's a single price, so it doesn't really matter. The only thing that changes, depending on who you trade with, is the commission. But all the same is the same for everybody. So we're away from the bucket shop mentality. But so like, I think these are the most likely candidates. It's still not signed, so things could change. But I have spent a ton of time working on this, and so I hope we manage to close the relationships as I have stated. So and the plea to you guys is, if you think, what are the most the trading platforms that you want, or other things that you think we should pay attention to, please go ahead and suggest with info@darwinex.com, the way you always do, because that feedback means the world to us. As I said, we internally work with Slack, and every single email with feedback we get is posted out for our meanwhile 32 employees to see, so that we're all working on improving on your suggestions. So yes, the exchanges will be for sure the main European and US ones. So we'll be doing that. Yes, our competition is listening, but ultimately, the idea is actually the easy part. It's actually about the hard work of doing stuff. So I'm not so worried, but maybe I should be more going forward. Thanks for the insight. So any questions, feedback? Do you guys like? Of course, we'll be looking for beta testers. So if any of you guys has a futures account and they want to test the system, we'll be more than glad to offer that. And of course, we can do an attractive pricing offer so that it's also worth your while. So anybody listening or watching the recording, which will of course be uploaded to the YouTube channel, feel free to volunteer, because the beta testers mean the world to us. Okay, well, without further ado, that really was what it was. We've now got half an hour worth of webinar, so I don't want to keep you guys going for much longer. Amujel, the minimum contract size, again, the minimum contract size will be the standard contract size for the relevant market. So that's the thing with going on exchange. We will not be able to change the contract size because there's only one single contract size, the one dictated by the exchanges. So you can look it up, for CME, the lots, and so on and so forth. I guess that's the core difference between forex over-the-counter trading and on-exchange trading. That there's no a la carte modifications by the providers. It's all as listed on the exchange. All right. Well, sounds like we're out of questions. So unless anybody has a question in the next 3, 2, 1 second, let me thank you all. Wish you a great weekend. It's always a pleasure. And as ever, any feedback or impressions or criticism, we do thrive on criticism as well, will be most welcome. So take care, guys, and thank you so much for attending the webinars. It means the world to us. I mean, you probably don't know, but like a couple of years ago, I was doing these on my own, so it feels a much, much less lonely place at this point. Take care and best wishes. Bye bye.